Hello, I'm Jim Harris, the owner and one of the senior loan advisors for Trusted Advisors Mortgage. This particular video will be about credit scores. Credit scores are also called FICO scores, F-I-C-O. And FICO stands for the Fair Isaac Company. This is the group that developed credit scoring years and years ago. Now there's several agencies that do it. But in general, your credit score should be somewhere in the range of 300 to 850. Below 620 is considered bad credit. Above 720 is considered good credit. And anything above 800 is considered fantastic. FICO scores themselves are about your payment and your credit history. They aren't about your income or your assets or employment history. Of FICO, there are different things that take up different amounts of importance. 35% of the importance is your payment history, your bills, bankruptcy, how well you've paid on credit over the last several years. Late payments are important. Anything that's been paid late recently counts more heavily against you. So if you had lates from years ago, you're okay, but lates in the last couple of months, that's bad news. About 30% of the FICO score is based on your outstanding loan balances. So 90% of that, of course, is credit cards. With credit cards, you want to keep a balance that is less than 40 or 30% of your limit. So if your limit's $10,000, you want your running balance to be $3,000, $4,000 the most. Anything higher dings your credit. Paying off your credit cards actually doesn't help with credit score and is a bit of a ding because it doesn't give history to the reporting agencies. Opening new credit cards also counts against you because the duration of that credit is very short. Again, you want long-term credit with lots of history of good payments. 15% of the credit score is based on the time that you've had credit open. So again, keeping the credit cards open for years is the goal. If you have credit that's only been open a little while, it reduces your score. 10% of the FICO score are the number of times that vendors have requested your credit score. So it's the frequency of requests. When you're getting a mortgage, you want to have your credit examined by everyone who you're talking to within a 30-day period. Then it doesn't count against you. But if you have your credit score pulled month after month after month after month, then you're going to start to see your credit score go down. 10%, the remaining 10% of your calculations for your credit score is based on what type of credit do you have. Installment credit for cars and for Visa cards and things like that, or mortgages and home loans. Those are a better vehicle to have. What does this all mean and why is it all important? A better credit score gives you the better cost and better choices for mortgages. So keeping your credit clean is helpful to you and your family in keeping your costs down. If you have any questions, this has been kind of technical, shoot me a text message or a phone call at 916-801-3940, or you can send an email to jim@trustedadvisorsmortgage.com. Thanks for watching, and hopefully this helps with credit scores.